Welcome to Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only. It doesn't take your personal situation into account. With all that said, let's get into our first chart. So I've got the SP 500 up here on the screen, and this has been one of the great recoveries from a sharp sell-off in a little over 2 weeks. Just a bit over 2 weeks, the SP 500, well, it's gone from a state of extreme fear to getting within a fraction of its all-time high. In fact, the equal weight S&P 500 already is at an all-time high. And in the process, S&P 500 has had 8 up days in a row. That's the first time that's happened this year. And we don't see that many periods where we do get 8 up days or more in a row. They're fairly rare. Well, they are rare events. So really extraordinary recovery from those from that fear-induced low. So should we expect a new all-time high and the resumption of the previous trend? Or is this rally about to stall out and turn lower? I've got a few charts to go through, and I'll tell you about a scenario that I think has a good chance of playing out. So just starting with the underlying structure that we have on this chart, this remains a market in an upward trend, and I think the default position should be to favor the incumbent trend. Nothing's happened to change that over the last few weeks, and I think this remains the case until we get evidence to the contrary. Now, at this point, there's no evidence to suggest that the underlying trend has changed. We also have this prominent V-shaped recovery. We typically get these when there's strong underlying interest in buying the dip, because to fuel such a strong rally, of course, you've got to get that buying interest. So that's what the V-shaped recoveries tell us, that you do have that strong interest in buying. I saw an interesting graphic on X this week, and it was somebody, they were overlaying the current price action with the 1987 crash, the infamous 1987 crash. Showed how prices have been rising, prices fell, they rebounded, and then they crashed. Really, I think people trying to plot a course for a crash are looking at this the wrong way. As I've been saying, I think the odds favour the incumbent trend, not a reversal. I think trying to pick a reversal in these markets, I think it's a low odds event. I think the odds favour staying with that incumbent trend until you get that evidence otherwise. This doesn't mean we should expect a continuation of the past 2 weeks. I think it's unlikely we see the past 2 weeks. I think trying to extrapolate that forward is a mistake in itself. I want to put on an RSI. Let's put on an RSI. That provides some interesting perspective around all this. And what we see with this RSI, like now we've got the S&P 500. It's closing in on an all-time high. Look where the RSI is. It's middle of the range. It's nowhere near its previous high point. My take on this is that the market has been moving at an unsustainable pace, like 8 days in a row up. That's not something, of course, which we should expect to continue into the future. If prices were to move higher over the next few days, make a new all-time high, would then have a situation of divergence, and that's where you have rising price but not being confirmed by the RSI. Now, of course, this hasn't happened yet because the market hasn't made an all-time high, but it's just laying the framework to suggest why maybe a pause is coming. Because it does seem like the rate of advance is not sustainable, and that leads into the potential for a pause. Now, if we were to get non-confirmation through an RSI, sometimes non-confirmation doesn't lead to much at all. Like there's this classic example, prominent example, just from last year, where we had declining RSI, but price continues to rise. So it's not this magic indicator that says price has to fall. But it is worth being aware of, and it is worth noting, because there are plenty of examples that look like this, where rising price with non-confirming RSI does lead to a period of weakness. Now, I'm not suggesting we're heading into a period of weakness like 22, but nonetheless, it's a potential non-confirmation, and the rate of advance of the current rally, combined with the RSI not keeping pace, which gives me cause to believe that maybe there's some consolidation coming. I think there's a high possibility that S&P 500 comes back towards the moving averages. So I've got the 50 and 100-day moving averages on the chart, and if we did get a pullback towards the moving averages, that would allow for some consolidation of these recent gains, and then potentially from there set up a platform for further gains. So one possibility, and these are of course just possibilities, we don't know how the price action would play out, but there are certain templates which we see reappear in markets over time. So one possibility would be the shallow compression back towards the moving averages over a few weeks. We get a new platform, and then from that new platform, we potentially look for higher levels as we move into maybe October, November. We often see this type of structure in bullish markets. Of course, many other things could happen, but I think the odds favor a bullish resolution from this period sometime later in the year. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching. YouTube shows other people. Helps me heaps. Please do that. And click that subscribe button if you haven't already done so. Now, just quickly, I want to show you this. This is the percentage of S&P 500 stocks above their 100-day moving average. This remains supportive. At least in my view, this remains supportive of the bullish case. In a true bearish phase, I'd be expecting to see this breaking down. I'd expect to see like lower levels, a lower percentage of stocks above their 100-day moving average. But instead, the percentage of stocks above the 100-day moving average, it's been resistant to moving below this market around 44, 45%. It's been consistently holding there, and we're currently up at around 70%. 70% of S&P 500 stocks, that is, which are above their 100-day moving average. I think that's supportive of the market generally. I think the play here, I think it's stay long. I think it's continue to use those wide trailing stops to see off this volatility that we do periodically get. This recent correction, yes, it was aggressive. Yes, it was unpleasant, but it was entirely survivable if you had an appropriate strategy. And that's what wide trailing stops are designed to do. And that is to keep you in your best stocks for as long as possible, but shut down risk when a pullback becomes just too much and a stock needs to be moved on. So look, let's leave that there for this week. Hopefully that's been interesting. Thanks for joining me. Look forward to seeing you again next week. Till then, bye for now.